All right, welcome to the Risk Reversal Podcast. I'm Dan Nathan. I'm joined by my very good friend, Imran Khan. He is the CIO and founder of Proem Asset Management. Imran, welcome back to the podcast.
Thank you. Great to be here.
All right, so last time you were on, it was in November, and we focused a lot on your process, how you think about investing, how you think about choosing longs, choosing shorts, thematics, and the like here, how you do portfolio construction, risk management, and it was a great conversation. We're going to put that in the show notes. Today, we're going to do three things. We're going to talk about just the geopolitics, how you kind of factor into that, your investment process and the like. And we got a lot of uncertainty, whether it's trade, tariffs, tax, deregulation, geopolitics, all really kind of important themes, I think, right now. We're going to talk a little bit about this concentration in the S&P 500. We've had two consecutive 25% plus positive returns in the S&P. We're going to talk about how you're thinking about that and where you see opportunities in 2025. And lastly, how could we do this? How could we podcast without talking about generative AI, thematics? You know, we had that DeepSeek sort of situation last month that really threw, I think, a little bit of a monkey wrench into the trade here in the public markets. But I want to get your take on all that. All right, where should we start, Imran?
Wherever you want.
All right, let's do the macro here really quickly, because I think, you know, there were some trades that started working late last year after the election with the idea that we're going to have a more pro-growth environment here in the U.S. How were you thinking about that then? And how do you think it's playing out into the new year? If you were hoping for corporate taxes going down, if you're hoping for deregulation, and maybe that means, you know, some different business practices by many companies or M&A and the like, how are you thinking about that? And how important is that to your investment process right now?
They're very important. I think one of the biggest learning lessons in 2022 that if you run a sector-focused fund like us, obviously you have to be very focused on your sector and be specialist about sector, but every sector is part of an economy. So you cannot ignore the economy. You cannot ignore the government. One of my biggest investment philosophy is invest with government, because government is world's largest monopoly. So, and I like people who are quote unquote monopoly companies, you know, so that's what we think about it. So I pay very close attention to the economics. You know, I think, you know, it's interesting. I look at the market, there are a lot of excitement and there's a lot of right reasons to be exciting. I think the deregulations will happen. I think the taking out the government spending cut is a very right policy for the country. And I think there'll be potentially a lot more M&A as the deregulation happens. All those things are positive. But then you also have this potential trade war, decoupling the global relationships. For a long period of time, we are open to this global economy that I think will change dramatically. You know, every country will probably become much more isolated, you know, in a sense. That's not necessarily the right word, but you know, we're going to have a less of an open economy that we saw in last 30 years, and rightfully so. You know, I think.
Well, open where? Let's talk about that for a second, because when I think about what's going on with Europe from a geopolitical standpoint, I think it runs the risk that we have less trade with Europe, right? If Trump is trying to impose, you know, tariffs on some of our biggest trading partners who happen to be our best allies, you know, I think there's risk to that. I think there's risk that, you know, some of the stuff that people were so focused on that was going to kind of take or have the economy inflect here, what lower corporate taxes and the like, I think you run the risk of a trade war lasting a bit longer than people think, because, you know, we have the playbook from the first administration. So are you starting to think that some of the positivity in and around all that stuff could actually fall by the wayside this year?
I'm not necessarily. You know, I think I grew up in an education system, and all of us at my generation grew up in an education system where we have been told that open trade is a great policy. And the reality is, yes, but I'm a big believer, as I think I talked about it, there is nothing 100% accurate on absolutism. You know, absolute free trade, I don't personally believe works. I think it's a bad decisions. And if you go to my wife from upstate New York, if you go to upstate New York, you go to the small towns in New York City, you see what the global open trade did to those communities. It's terrible. It's terrible. We lost a lot of jobs. It ruined our small towns and against the government policy. So I think there is a point to it that we cannot have a complete free trade. I think there has to be a balance. And whether President Trump is right or wrong, only time will say. But I think I think we're going to find the new equilibrium. What is the new economy of open trade looks like?
There is an irony to all that, because a lot of these large FTC and DOJ investigations to our national champions, these massive tech companies, they did start under Trump 1.0, right? And when you think about tariffs and the like, those didn't change much under the Biden administration, right? And both of the administrations were responsible for throwing trillions and trillions of dollars, you know what I mean, on the budget deficit and the like. And so when I think about what we're in for right now, it might just be more of the same, you know, and I go back.
I don't know about that. Again, I think there's a lot of uncertainty in the economy. I think inflation is sticky. You know, there is a high degree of probability that we're not going to see. I actually think there's a significantly high degree of probability we will not see any rate cut this year.
Yeah.
And I think it is more than 0% probability that Fed may have to raise rate.
Yeah.
You know, so that's a pretty significant headwind. I think on a trade war side, I'm reserving my judgment whether they're good or bad. I think the issue here is that it will create uncertainty.
Yeah.
And the market doesn't like uncertainty. However, going back to this point, I think President Trump 2.0 versus Trump 1.0, I think is different, because I think when he first came in, regardless of your opinion, you know, governing versus campaigning is very different. And we saw that with President Bill Clinton.
Yeah.
The first year or two was really tough. So when somebody who is completely outsider in Washington, D.C., you don't know how to run the government. And I think now he has more experience. The second thing is, regardless whether you like President Trump or not, I think he has proven right in many points, which we got to give him credit. You got to be objective. You know?
Which ones?
Listen, I think his point of view about China, before nobody talked about that concern about the China. I think some of the issues that he's raising about our allies, you know, whether we may not like the way he's going about it, you know, it's not necessarily completely false either. So
well, that is a subjective view.
Yeah.
I mean, like, to be honest with you, because half of America probably disagrees with that too.
Yeah, but half of America does agree with that.
Yeah.
You know, and so I think the other thing is, I also think he has my opinion, you know, you might disagree, that seems like he has a more competent team around him.
Oh, see, I take the opposite side of that. But again, if you go and look at the cabinet he put in place, you know, in 1.0, and you look at the credentials that they had versus what we have now, I mean, I think that's night and day. You just mentioned lessons from 2022. And I think that's really interesting, because the pace in which interest rates were raised by the Federal Reserve, I think, caught a lot of investors off sides, right? So they basically came to the conclusion in late 2021 that inflation was not transitory. They said they were going to start to raise Fed funds rate. And at that moment, in the Q4 of 2021, like these long duration, high valuation, whatever you want to call them, you know, risk assets started to sell off. And by, you know, I guess Q4 of 2022, we saw the NASDAQ down like almost 40%. We saw some of the biggest sort of names within that index down. Some Meta sold off 77% from the highs in 21 to its lows in 22. Netflix, Nvidia, Tesla, all down more than 65%. So you just said that there's a potential that there's no rate cuts this year, possibly raising rates. That should be, if you're using the 2022 playbook, a bit of a headwind. I'm not talking about some of the biggest names going down 65, 70%. I'm just curious how you're thinking about that when you look at the landscape, you think about the macro right now.
I'm very cautious, period.
Yeah.
You know, I think interest rate going up, you know, like, is not necessarily a great scenario. You know, again, I'm not saying the interest rate will go up, but I think it's definitely more than 0%, maybe more than 10% probability that Fed will have to raise the rate. But I think, in my opinion, more than 80% probability that rate doesn't come down this year. Yeah. And you know, listen, that's a headwind. I think it's different than 2022 was. 2020 and 2021, the companies became very bloated, you know, and they hired way too many people. The company's culture changed very dramatically. So we don't have that anymore. But you also, on the other hand, being completely objective, you have a massive CapEx spending going on. And we have to see what's the ROI from those CapEx investment. So, you know, I think I'm more cautious, you know.
It's interesting. And again, until a lot of those major bloated companies started making those sorts of job cuts, and that started to happen in late 2022, that's when the stocks bottomed, right? And so it didn't really matter that Fed funds got above 4%, the 10-year was above 4%, because in 2023, it really set the stage for the companies that got leaner, right, and got more focused. You did have the start of that CapEx cycle for generative AI, and I think that helped a lot of the big names or so. So I guess my point is like, if rates just stay here, if the 10-year stays at 4.5, the Fed funds stays at 4.5, they're focused on bringing down inflation, and the economy keeps chugging along at 2.5%. That's okay.
Yeah,
right?
market that will do well, right? Listen, I like in 2005, 2006, market did fine, and the interest rate was around same, right? So I don't think interest rates staying flat is a problem.
Yeah.
If interest rate goes up, can it be a problem? Maybe. I think that's not priced in the market. However, I think the most interesting thing for these companies is, for technology, it's probably one of the most exciting time. It's like, honestly, in my life, I went through couple of cycles. When people are first building website, then we went through the SaaS transition from on-prem, then went to the mobile revolution. This is going back 25 years ago, internet, like the amount, like I played with some Grok 3 yesterday. It's like the fact that I wake up in the morning and ask Grok 3, tell me all the tweet summary of different stocks, and that it send it to me on a real time. That's pretty. So
amazing. Let me ask you this really quickly. So if you were to do that on ChatGPT or Llama or Claude, that sort of thing, did Grok 3 do that much better? Did you compare it to some of the other ones?
Yeah, there's some things they do better.
Yeah.
Again, I don't think who's going to be the winner on this ChatGPT story is been told yet. My personal view, ultimately, it will get commoditized.
Yeah.
And so at that point, the companies that have the biggest distribution going to win.
By the way, Satya Nadella, CEO of Microsoft, I was reading an article in The Information this morning, was saying exactly that. And I think it's one of the first times he's really come out and said that. And he said, yeah, we're doing $80 billion supposedly in CapEx this year. Half of it's going to be outside the US, but they're also doing a lot of leasing of the data centers and the like, because he worries about an overbuild, overcapacity. You don't get the use cases right away. And that's kind of not too different than the internet. So talk a little bit about what the excitement was in the stock market in the late 90s, and then how we saw, the NASDAQ and many of the names that are now trillion-dollar market cap companies, Microsoft lost 70% of its value. Amazon lost 90% of its value.
I am very constructive on these companies, but I'm a big believer of being objective. Yeah. This is my biggest pet peeves with investors, that they only talk about their book and they don't be objective. What do we know about these internet companies? They didn't see they've overbuilt their business in 2021. They understood that they thought all these guys, they're great CEOs, I really admired them, but they all thought 2020 was a baseline.
Yeah.
And now what gives you the confidence the same guys not going to overbuild the CapEx?
Yeah.
I think it's a serious question to ask.
I've been asking the same. You and I talked about it offline. I agree. So let me ask you this. When you say...
No, don't give blank check to anybody.
When you say Satya says we're going to spend 80, when you say Andy Jassy says we're going to spend 100 or whatever, up from 60, you hear Meta, so it's Meta, Microsoft, Google, and Amazon. They're all talking these huge numbers, hundreds of billions of dollars. What do you think the probability of them not hitting those numbers are this year? And I
think this year they will hit the number, because the way, I ran a large company, the way the large companies work, they plan it significantly ahead, so they're not going to change their CapEx budget in 1 week or 2 weeks or 3 weeks. That's just, when you're running a 72,000, 100,000, 200,000 people company, they don't do that.
Here's my pushback, though. In 2022, lots of job cuts happened across all of those companies because of the overbuild.
But they were late, though. They were late. They didn't cut. First of all, they overbuilt it. You saw the sign in 2021. Their stock had to get punished before they did it.
Why is it different, though, now? If you've built out all this capacity, now you have guys like Oracle and Stargate, coming in with OpenAI. I don't understand why that would be too different, because if they've overbuilt capacity in the data center front, they bought too many Hoppers and Blackwells and all that sort of stuff, and then their customers don't see, the uses right now, don't they cut that CapEx?
I don't think, my opinion as an operator, become an investor, it's hard to do it immediately.
Yeah.
It'll show up in 2026, 2027 if they do that.
But the stock market will start discounting that ahead of time.
But if they cut the CapEx, that's a good thing for these companies.
Yes.
Again, I don't know what's going to happen, but I just don't think if they gave the guidance in February, I just think it's already planned. It's going to be tough to do it. But again, let's play the psychology game, because I think it's really, really important when you invest, understanding your manager's incentive, right? So at the end of the day, these guys are also smart enough to know that they have kind of asymmetric risk here. So if they don't invest and they lose out, their business going to get cut into half potentially. Yeah. If they overinvest, guess what? They might have a one bad year in stock, but they're going to be fine, because over time you will need the capacity. Yeah. So it's not like, yes, we might overbuild it. We might have a glut of servers and GPUs for 2 years, for 3 years. That's the max. You will need that. The world will get there. So if I were running a company, if I were I always like to think about it, these guys are smarter than me. So if I were running Google, if I were running Facebook, if I were running this, I would invest like a drunken sailor too, because the risk is I will be remembered that Imran is the guy, who destroyed this business, versus Imran is the guy who spent 2 years more money in an arm race. It didn't work out. Not a big deal. So to me, it's like, how as a CEO you want to be recognized. Yeah. So I just don't think in a shorter term they cut capital.
Well, by the way, the stock market is giving them that leeway, right? So if you look at the performance of a lot of those names, Meta in particular, they're basically saying, okay, go ahead, have a ball. We'll deal with it on the other side of it. But by the same token, Google, Microsoft, they kind of been stuck in the mud a little bit, or Microsoft clearly, and maybe that has to do because they were one of the early beneficiaries of the trend. You tweeted out something the other day on the 16th, which I thought was really interesting. I think it was something from Goldman Sachs. It was talking about the market's dependence on a large cap, on a small group of names. And you have to go all the way back to 1932, where we just took out that number. We're far above the year 2000. So right now in the S&P, the top 10 names make up more than 30% or something. Why is this important to you?
So I think if you take a step back, when you look at NASDAQ and say half of the QQQ is 10 stock, what does it tell you? It tells you that these guys are ultimately net share taker. Now, that, to me, you can believe if you believe that AI will be a closed loop system and only few guys will have that. So if you think AI is like a nuclear weapons and only 5 guys in the world will have nuclear weapons, then they are the superpower and they're going to capture more market share and they can overcharge their customers, and that's great. However, if you believe that ultimately AI will be more of a commodity product that everybody can access, and that's why I think the DeepSeek is so fundamentally interesting. Regardless how much it costs, then you can see the balance of world's power going to be very different, because then somebody who has great install base can take these AI tools and build clever product on top of it and will capture the GDP share. Right? Because ultimately, what decide the market concentration? Who's going to have the biggest power of the GDP? So that's why I think that this concentration, you might have to start thinking about it. The second thing, I think you have to think about it. If you look at the these top mega 7 names, not all of their fundamentals are equally good. Because if you can argue, right, if the CapEx cycle going to continue for 3 years, phenomenal for Nvidia, phenomenal for Broadcom. If the CapEx cycle going to slow down in 18 months from now, it's actually better for Google and Facebook and those guys, less so for Nvidia.
Because they've already built out the infrastructure.
If they're not growing CapEx 15, 20%, every year.
Get a lot of leverage on those investments.
If you have a flat CapEx 1 year, what does that mean for Nvidia stock? So when you have the mix of companies where one gets benefited, other become potentially loser, that's not good for overall index, right? So there will be a winner, there will be a loser. So if this CapEx cycle grows like this, 20% for next 3 years, I think Google, Facebook, Meta, we got to rethink about their stock valuation, right? But you have to rethink about Nvidia's growth potential. But if it flips the other way, that 1 year the CapEx doesn't grow, still spending a lot of money, think about it. Like all I'm saying, the CapEx is not growing, not declining.
Yeah.
If CapEx cycle doesn't grow for hyperscaler for 3 years, whether it's 27, 28, 29, or 26, 27, 28, I don't know, then Nvidia's growth will slow down significantly, So So that's the way you have to think about it. The world, and then Apple has their own issues, right? And then if you look at the stocks, they're not necessarily cheap stock. They're not bargain. So I think listen, I own many of these stocks. I'm not here saying poo-pooing on the stocks.
Yeah.
All I'm saying is that we gotta be cautious that and be objective about all the stocks we own.
Well, let's play out that theme for a second here, because I think if you look at Microsoft's CapEx, the growth has slowed, right? And so even Meta, it's slowed a bit. They were able to use a lot of the spend from 2021 on the metaverse into what they built here. Amazon's the one that just jacked it pretty high, from where they were last year. And again, they have not been one of the ones that built one of these foundation models and the like. And they built, really the superstore for anyone who wants to come there. And they have a huge installed base of enterprise customers, obviously small, medium, also. When I think about the potential for, let's just call it flat, let's not call it down, right? And I say to myself, who is going to benefit from here on out to a flat CapEx cycle? You just talked about NVIDIA runs some risk there. Which ones are you most excited about the opportunity to see some of their competitors who didn't gain the market share after the build, right? Which names here do you think benefit in a flat sort of CapEx environment where you're starting to see an uptake of some of these, the compute?
So if you think about it, right, more fundamentally what happened? If your revenue grows 20% and if your CapEx dollar stays flat, what does that mean for free cash flow? So you're going to see pretty significant free cash flow growth. And I'm a big believer the free cash flow expansion actually drives stock price higher, everything being equal. So I think that's good for Meta. That's good for potentially Google. Obviously, they have other things that you have to worry about.
And that's why you've seen the Meta outperformance right now, because...
But I don't know about that necessarily. I think Meta outperformance was they had really had a good quarter. So if you look at the Max 7, and you be very objectively, who had a good quarter? Meta had the only company that I can remember top of my mind right now among the Max 7 whose revenue growth rate accelerated.
Yeah. Well, Apple was disappointing. NVIDIA we're going to get next week. Microsoft was disappointing. Amazon was disappointing. Google was disappointing. Tesla was an absolute disaster. Yeah. I mean, the fundamentals there are like horrible. Yeah. And Broadcom was pretty good. But they were late to join the party. All right, so how does DeepSeek, in your opinion, upset the apple cart here? What were your biggest takeaways? Because the market on that Monday, I think it was Monday, the January 27th or something like that, NVIDIA closed down 17% on the day. I mean, the whole Mag 7 got destroyed. Overreaction, in your opinion? A lot of them have come back from those lows.
Short term, hard to say, but I think the most important thing is that it raised some legitimate question. Regardless how much they spent, one thing we can probably say with high degree of confidence, they didn't spend like OpenAI. Mm-hmm. Right. So
it wasn't $6 million training the model,
but it's not $100 billion either.
Yeah.
So that, I think at a minimum, I think you can say with high degree of confidence that there is an opportunity to productivity improvement in all these tech companies. And my experience with these tech companies is also that this thing came so fast that they all probably joined the arm race without thinking about productivity improvement or efficiency improvement, And again, as I said, I'm a deep respect for these founders and CEOs. They have done a great job, but you should not give blank check to anybody. These are the same people who overhired in 2021. So I think, my sense is there is room for efficiency improvement, and there's always room for efficiency improvement. And I think, me being an operator, right? One of the things I learned that, engineers, you cannot give them too many tasks to do at the same time. You got to give them one marching order. Right now, obviously their marching order is to win the race and build the best product. But at some point, you have to give them the marching order that said, hey, go improve the efficiency. And that is the single biggest focus. So I think, so I will be shocked, that in 2 to 3 years, we don't see pretty meaningful productivity improvement out of it. Efficiency improvement out of it. But I don't see it's a priority right now for big companies. But I think it might become a priority in 26, 27.
All right, so let's move away. You're talking about the productivity gains that these companies themselves will kind of realize. But what about you're a tech-focused investor? Will you start looking at other industries as they start adopting these products and services to kind of focus on their own efficiency, their own productivity? Walmart is maybe a good example. It's down today, disappointing results. But in the last quarter, they accelerated their e-commerce growth, and they were talking about there was distribution and fulfillment and customer service. I mean, some of the investments that they they had made in generative AI were helping that growth. So will you start to look at other sectors, how they might adopt this technology?
And I'll look at names, other tech names, right? There is a 1,000+ companies that's over $1 billion market cap. There's a 990. I think what I learned from going through different cycles, that each cycle has their own uniqueness, right? So to win on the web 1.0 versus mobile 2.0, or winning SaaS versus on-prem versus now with AI, who is going to be winner? Each of the cycle has their own uniqueness. However, there's a one common thread among all four. Do you know what is that? Execution.
Yeah.
You have to execute. Because I always tell people, you and I have this. People always say, "Hey, what's so secretive about your stock you own?" I'm like, "There's nothing. You can give the same ideas to others; they will not execute the same way." Execution is difficult, and same thing for the company. So I think this is the time. The way I look at it, who are the big winners going to be outside? If you think about the broader world, forget about the 10 big cap names, is the companies that have big install base, because then you can roll it out faster, because customer acquisition remains very tough, very, very tough, right? If I go build the same product like Grok 3, I'm not going to get the same distribution that Grok 3 is getting, right? Because he has the Twitter distribution, he has his own follower, so he drives that, right? All the media likes to write about him, so that drives, that distribution is super, super important. The second important thing is companies that have a lot of data, right? So because AI without data means nothing. So those are the two very unique to be successful. And then the third one is the common thread that we saw all 4 cycles that I have experienced in my lifetime is execution. Which are the management team will execute the best? And I think you really have to question, right? Right now there is a chaos in my mind, because the entire world changed dramatically, and then the right leader is going to navigate that better. So I'm paying a lot of attention who's going to execute better.
All right. So you hear this all the time, different cycles, specifically in technology, that, a handful of them go by the wayside, right? Some of the biggest winners in different, periods and the like. And I look at, and I love what you just said. You like to invest in monopolies. You like to, and when I think about Apple, I think about NVIDIA. I think about Microsoft. I think about Amazon and Google and, Meta, maybe not Tesla so much, but they're basically, the moats are massive. Their distribution is massive. The amount of data I'm hitting on some of the things that you just said is massive. The execution has been phenomenal. Even in a company like Apple that was kind of in the penalty box, relative to some of the other big ones, I would just focus on 2 of the things that you just mentioned. Even if Apple Intelligence sucks, which it does, even if we can't see what it's going to look like in 2 or 3 years, it's probably going to be pretty good then. But they have the ability, they have the distribution. They have 1.5 billion, iOS installed, So do you look at names like that and say, it sucks now, the valuation might be high, they might have pulled forward some excitement, but this is a stock, this is a company that I think has great potential, They didn't have to be first, but they might be, a real winner, if I'm looking at 3-5 years out.
Yeah, so there are 3 things. Number one, you are absolutely right. They are sitting on a lot of great assets. That's super, super valuable, and that their moat is very, very high that you need to potentially pay attention to. But one thing we learned in tech, monopoly doesn't last very long. Right? Somebody somewhere come. I always like to say that I don't actually worry about bigger competitors. I worry about the competitors that you never heard of. All
right, well, let's talk about those, because again, if you just said you're slightly cautious on some of the big ones and you like the themes, and I'm sure going to be invested in and out of those over the next 5,
I'm invested
10 years.
in many of this currently.
Yeah. So when you look, where are you going further afield down the market cap scale? Because, we had Jeff Richards of Notable Capital. He's a great, I don't know if you did Jeff, great VC tech, former operator like yourself. He was saying, I think you want to look down, the market cap scale. There's a lot of great companies doing a lot of great things and around that. You don't know of them. But I go and look at a couple that he mentioned, and I was like, Jeff, they still trade at 40 times sales. These sorts of things, they're kind of uninvestable because the stock market has been looking for these sorts of things. So I'm curious, where are you looking for the 2025, 2026 opportunities? Because we're not going to talk about your performance other than the fact that I know it's been really good. We've had 25% consecutive S&P years. you don't need a 25% gain in the S&P 500 for your fund to do very well. You just need to pick themes and stocks that work within those themes.
Yeah, listen, I think there are companies like, like in the past, we still own Tulio. Like we own DocuSign, right? For example, I think on a valuation basis, they're relatively cheap. I agree with you that you cannot go down the downstream and pay for companies that is significantly premium to these companies that have strong moat. To me, if I'm paying for a company that is growing at the same rate as Meta at a higher multiple, why own that? Meta is less risky, for everything that you pointed out. So I ask that question a lot. Don't go buy small mid cap just for the fact of it, because small mid cap names are like teenagers. So they can be genius or they can be a complete disaster. You don't know. So overpaying overprice doesn't make sense. So we've been very valuation concerned across the board. But we're also looking at companies that we think has a strong data and install base, and the management team we think we can trust to execute.
All right, I got one for you. And I'm just going to throw this out there. And maybe if you don't want to talk about it, you don't want to talk about it. Look at Zoom. Okay, here's a company where growth has just stalled. I mean, maybe low single digits earnings and sales growth, but margins have really actually started to improve a little bit out year over year. It's got a $19 billion enterprise value. I think, over a third of that is in cash, right? You say to yourself, the stock's up 50%, from the recent lows. You have data. I don't know if you can trust the management or you like their execution.
The founder is pretty good.
Yeah. But what I'm saying
is anybody
who
built a $20 billion plus company is pretty good.
Right. And this, at one point it was $100 billion. You know what I mean? So my point is like this the sort of thing that you would start kicking the tires on. It trades at 15 times earnings, and there's probably a whole host of things that they could do with that data. You know what I mean?
I think Zoom is pretty cheap.
Yeah.
Now I would say I have a very small position on it. I would say Zoom, my concern with Zoom is I'm not so sure I understand what will take it to the next level. But that's, as you pointed out, it's very cheap. My view is like if a company is trading at a 10, 12% free cash flow multiple, 10, 12 times free cash flow multiple, you can just buy back share all day long. If as long you can say that if I have a business that's trading 10, 15 times free cash flow, and as long as I have a confidence that it's not going to go down, if you just buy back, you're going to get 7% accretion, And so to me, it's like, that's fine. Where I struggle with DocuSign versus Zoom, they have a new product upgrade cycle coming up. I think that could be very, very interesting. Zoom, I'm not sure if I understand their next product upgrade cycle, how big it can be. And that's something I need to really understand. Like it doesn't have to be big, but can it accelerate the growth? We haven't seen that.
Let's go back in the last 10 years, Microsoft bought LinkedIn. People didn't really see why, and look at how well that transaction has worked out. You could also go to Slack and Salesforce. I'm assuming, that's worked out pretty well. These are both, I think, like $25 billion deals or so.
It seems like LinkedIn might work out better than
but like this one seems like Zoom could be a really easy bolt-on. You know what I mean? That for one of these companies, maybe it's Cisco, maybe it's Microsoft,
could be.
Or something like that.
Or they have a big install base and they will do something interesting. No, but listen, I think with Zoom, that what's intriguing to me is that you have a founder. Yeah. He's a repeat founder. He has done well. Has a very good track record. He is tech mindset. He's technically savvy. So because one of the biggest things is that I cannot go run a tech company now because AI is so like you have to be a little bit more tech savvy than me. But I think can you go run in 2015, 2016 a lot of the tech companies, because the tech was not that sophisticated.
Right.
At the end of the day, Uber, DoorDash, they're not necessarily AI company. And that's I think their big risk with some of these businesses are. So I think my personal bias is in this kind of technology chaos time, I probably think about it. Let's say you were sailing, and if there is a dark cloud, you hope that you have a very experienced and knowledgeable captain. Mm-hmm. So if this whole technology thing that comes out that fundamentally changed the world, you need somebody who has a deep understanding about tech. And I feel like Eric has that.
Yeah.
They have a big install base, they have a lot of data, and the stock is cheap. So it's a very intriguing company. But like I said, I have a very small
Let's
position.
start kicking the tires on the Zoom. All right, last question before we get out of here. You mentioned that you were an operator. You were COO of Snap. Okay, you were talking about, you just mentioned what technology was like back then and the like. And, this is amazingly sticky product. If you have children, you know what I mean? And they still use it all the time. The stock has been stuck in the mud. It's at $10.50 right now. It has a $19 billion enterprise value. Earnings and sales are expected to grow double digits, right? It's got a gross margin, that's the problem. It's like 55 if you look at compared to some of its comps.
That's a little bit misleading because the way it's accounting issue, right? Because Snap expense their data center because they don't own data centers, right? They use AWS. Google and AWS. But Google is the biggest one. So they're actually paying Google. So that's cost of revenue. Whereas if you look at Facebook of the guys, they own the data center. So they're amortizing the cost. So I think it's kind of a misleading, so the CapEx is much lower for Snapchat as opposed to Facebook.
Yeah. Do you find it intriguing here? I mean, like this was obviously a COVID play. The stock went from 10 to 80. Now it's 80 to 10. And, again, the price doesn't really matter, but it really doesn't go anywhere. And I'm just curious.
So I'm biased, but Evan is my friend.
Yeah.
And I think he's one of the most exceptional product leader in the market.
Yeah.
And again, I worked with him. He's a great friend of mine. I really, really think he's one of the greatest product mind person right now. And listen, on his credit, everything that Facebook is talking about, he talked about during the IPO, calling Snap as a camera company when everybody made fun of him. And now everybody is like,
by the way, I still have the spectacles. Yeah. And I'm telling you, the spectacles are basically the same exact thing of these Meta AI glasses.
Yeah, exactly.
And they were like the same price point, and they were 7 years before.
It's 7 years before. So Evan is a great product mindset. And I think, you never underestimate a person who is an incredibly product innovator because they will surprise you.
Well, he was at your conference back in October, and it was one of the first times in a while I had seen him, talk in front of an audience like that. He's one of those guys, everybody likes him and everyone likes his vision. And
I'm just one of the nicest person out there.
I think it's a sort of stock you kind of close your eyes and you know what I mean? It's probably
I think,
a double at some point.
Evan is really, really special, and look at his track record.
Yeah. Yeah. Well, I'm rooting for them. I like him. He seems like one of the good guys. All right, Imran Khan, you're also one of the good guys. I really appreciate you coming here, being on the Risk Reversal Pod. You know that this mic is always open to you when you're in New York City. So I hope you'll come back really soon.
Great. Thank you.